Hello, I'm Peter Mauthe with Trademark Capital Management. Today, we're going to discuss the December 2023 Fed meeting at which they announced that they were going to be leaving interest rates steady for the time being. We'll also take a look at what we might expect as a result of that. As we move to our next screen here, this is the history of the Federal Reserve Fed funds rate going back to the middle 1990s. That's the black staggered line here in this graph. The green line is the 2-year Treasury note yield. The reason we overlay these is that the open market determines the 2-year Treasury note yield, while the Federal Reserve pegs or has a stated federal funds target rate. Now, the important thing to pay attention to here is that the 2-year note tends to lead the Fed funds rate with quite a bit of accuracy. The important periods that we're paying attention to now is after significant increases in the Fed funds rate and the 2-year Treasury note rate. When the 2-year Treasury note rate falls below the Fed funds rate meaningfully, that tends to signal that the Fed is done raising interest rates. More so important this time is also, if we notice here towards the right-hand side of the screen where the question mark is, the yellow shaded level is 5 to maybe 5.25%. This level historically has acted either as a floor or a ceiling for the Fed funds rate, and we're once again up to that level. Also note, as in the noted locations 1, 2, and 3 previously, the 2-year note is once again moving well below the Fed funds target rate. Now, this did happen earlier in the year with no success on behalf of the leading indicator nature of the 2-year note, but this time appears to be so, that it will be signifying the Fed is done. Well, let's look at what this might mean for the stock market. At least historically, we can see these points 1, 2, and 3. And on a different graph, taking a look at the stock market, this is the S&P 500, going back over approximately the same period of time. You can see that at points 1, 2, and 3 on the prior graph, when the 2-year note signaled the Fed was done raising rates and in the foreseeable future likely to lower rates, you can see where this has happened historically on the S&P 500 chart. That happened towards the end of the move in the tech bubble of 2000, just before the financial crisis at point 2 in 2007. It happened in 2019 to a lesser extent, and that preceded the COVID crash, as we refer to it, in 2020. Now, here we are today at the upper right-hand corner of this graph, and we may be seeing a similar setup as to these prior 3 times. So, of course, we can't really predict the future. All we can do is learn from the past. We'll see how this unfolds in 2024. Now, in summary, yesterday at the end of the meeting, Fed Chairman Powell did make the following comments. He said that the Federal Reserve Open Market Committee was looking for the GDP of the United States to be approximately 2.4% this year, 1.8% next year, and an even slower 1% in 2025. He also said that this would indicate, based on the Open Market Committee dot plot, that next year the Fed funds target rate is likely to average around 4.6%, and the following year, 2025, 3.6%. Now, what does this mean for the stock market? Well, the stock market today on the S&P is in the low 20s as far as a PE goes. The NASDAQ 100 is over 30 times earnings at this point in time. So it's not like we're starting this interest rate cycle, if indeed we are going to start the cycle next year on the declining side of the trend. We're not starting from a point of attractive valuations in the stock market. Now, of course, we don't know what the PE during 2024 will end up being, nor do we know in 2025. That's for future editions of this segment. And for now, you can reach us at Trademark Capital at our website, on Twitter, YouTube, and LinkedIn. Please join us again for future segments on the Federal Reserve Open Market Committee announcements.